The stock market is continuing its momentum as yesterday's Q4 GDP report came out higher than estimated at 3.3%, which shows that the economy is still strong and resilient despite the Federal Reserve's rapid pace of interest rate hikes and a high level of about 5.5% right now. That GDP growth still shows the consumer is resilient because consumer spending is about 70% of GDP, partially because consumers are taking out increased amounts of credit card debt in order to make ends meet, but and depleting some of their savings. But either way, that's leading to the strong Q4 GDP numbers we saw yesterday, which led to the stock market's gain yesterday. And then today, the stock market is trading slightly up today because the Federal Reserve's preferred inflation measure, known as the Personal Consumption Expenditures Index numbers, came out lighter than estimated, especially for core PCE, which is minus volatile food and energy. That came in at 2.9%, which was less than estimated and less than the prior month. And in that 2% level is something that the Federal Reserve wants to see, although obviously it's 2.9% is closer to 3%. That shows more progress on the inflation front, and that is the lowest core PCE reading since early 2021. And then the headline year over year number for PCE was at 2.6%, which is about in line with estimates and from the prior month. But the fact that regular PCE is in the mid 2% level is something that I think the Federal Reserve will be comfortable with in perhaps giving interest rate cuts later on this year. We don't know if those will happen in March. I don't think they will because the economy is still strong and resilient. I think that interest rate cuts will happen in the third or fourth quarter of this year. Obviously, we have to see. But I think that the strong GDP report combined with the lower than expected inflation numbers for PCE shows that the economy is still growing while inflation, although obviously still going up, is going up at a lower level and moderating. So that's something that the market wants to see and why the market's been trading so well. We also have two Magnificent Seven earnings. Netflix beat on revenue and earnings per share, and their subscribers were much more than estimated, and their stock popped. However, that same wasn't said for Tesla. Tesla missed their revenue and earnings per share, and the Tesla conference call, frankly, wasn't really that great. Elon was a little bit all over the place. Yes, there's going to be a strong long-term vision with Tesla, because I still view Tesla as not a car company, but an AI, robotics, and clean energy company and a tech conglomerate. But Wall Street is disappointed that Tesla keeps missing their revenue and earnings per share numbers. I still view Tesla for their long-term growth story, but Wall Street sometimes gets impatient with it. Elon Musk kind of teased the next generation vehicle that will be less than $30,000, but that probably won't be released until 2025. As a result, I think Tesla's revenue growth will not be the 19% that was in 2023, but will be closer to 13 to 10% in 2024 this year because they're focusing on that next gen vehicle. Wall Street doesn't like that because they want to see that higher revenue growth. I'm trying to look past it because that next gen vehicle will add to more growth for Tesla, and that probably won't be produced really until 2025. But I'm still optimistic for Tesla because as a lot of legacy automakers are backing and pulling away from EV spend, Tesla is still going full force. And yes, Tesla is cutting prices and their margins aren't that great now, but I'm still optimistic on Tesla's long-term growth story. And one other thing I wanted to add. Although the S&P 500 is hitting record highs day after day the past week or so, the same can't be said for the Russell. The Russell is still in bear market territory. What that means is that as a contrarian investor, since it's technically in bear market territory, while the S&P 500 is in bull market territory, that's actually never happened before. And as a contrarian investor, that's why I think small and mid-cap stocks will do very well this year, and why I think FundStrat says those kind of stocks to be up 50 to 60%. We have to see, but that leaves me very optimistic for small and mid-cap growth stocks.